Good evening, everyone, and welcome to the Matter Money class, where we give you the insider information about all things affecting your income and your cash. Everything from money behaviors, money management, credit, insurance, and of course, investing. Yes. A lot of you all like learning about investing. So we're going to have some more classes about investing, especially about that Bitcoin and those cryptocurrencies. There's a lot going on. So we're going to have a class about that in July. But today we are talking about how to teach kids to invest. You start them while they're young and then they grow up to already do it. But for some of us, we weren't taught when we were young, so we need to be taught so we can teach our kids. Yeah. So we can teach our kids, and Valicia, my BFF, stop calling me during class. You know that's really bad, okay? So today we have a special guest, but before I introduce the special guest, I do want to give you all a few announcements. Number one, I have some bad news. There will not be any class next week or the 4th of July weekend. I know you're crying. It's okay. It's okay. We'll be back the second week of July, and we're going to be hitting it hard. So stay tuned for those topics. The next thing is, if you are on the West Coast, California, near Los Angeles, in Los Angeles, I'm coming out to you July 22nd with my Boss Brunch. It is called Boss Con. It is a business owner success strategies mini conference, and we are going to talk about how you can get bigger brand exposure for bigger profit. So I have all of the mega PR and marketing people who have expanded their brands and made money from it, and how they did it, from using social media, from writing a book, from writing a blog, as well as building national networks. We're going to show you how you can build a bigger brand for pennies and get some bigger bucks in there. So if you want more information about how to attend the Boss Brunch from the East Coast all the way to the West Coast, go to bossbrunch.net. That's boss, B-O-S-S, brunch.net, and can't wait to see you there. Also, go to mattermoney.com if you'd like to look at all the other past Matter Money classes. And this class is brought to you by Acorns. It's a lovely investment tool where you can invest with just $5. And hey, if you invest today, $5 is on me. So you get $5 to start up your Acorn accounts to get you started, and then you can invest $5 at a time or more or whatever. The best time to start growing a tree, if you want to feel the benefits of the leaves and the fruit, is to plant the tree now, okay? So that is the best way to do it. Start small and let it grow. So tonight, we're talking about how to teach kids to invest. And y'all know where I find all of my experts. Social media. Met this dude, I think on Facebook or Twitter. It was Facebook, probably. Prince.
Yeah, it's Facebook.
It was Facebook?
Yep, it was Facebook.
Man, I be meeting the best people on Twitter and Facebook, man. I met this guy on Facebook, right? And he just kept stalking me, right? And then he was in Georgia like, T, I'm in Georgia. I'm going to be recording my show. Need you to come. And any opportunity that I have to come in front of a camera. Oh, and support a friend. I'm always there for you. And so that was the first time we met. He came all the way from Honolulu, Hawaii, Oahu, Hawaii, where I spent the 4 years of my life, from 6 years old to 10 years old. I still remember my address and phone number, Prince.
Oh, wow.
9462 Makalika Court.
Wow.
422-8706. I still remember that. I was like 6 years old. Okay. But thank you, Prince, so much. What time is it where you are now?
It is 1 o'clock in the afternoon.
It is lunchtime. He has taken his lunch break just to spend it with us. I so appreciate you for that. And you are the master at teaching kids to invest, because you wrote an awesome book. But before we talk about your book, tell us a little bit about you, what you do, and of course, the books that you've authored.
Me, about myself, as you guys heard, my name is Prince Dykes. I guess I'll start myself off. I was introducing the finance while serving in the military, United States Navy, 14 years now. I was right out of high school, 32 years old now, married with a 6-year-old son. Uh, I got my interest as a logistics specialist, went on while I was serving and got my associate's bachelor's and MBA on my different Series 65, Series 63 license, life insurance licenses, and financial education, instructor's license, stuff like that. And I started my own company, Royal Financial Investment Group, officially in 2013. And it was just, hey, this is what I want to do once I'm out of the military one day. And I was just putting stuff up on Facebook, met awesome people like Tarra along the way. Then it turned into a YouTube channel, which you guys can see behind me, called The Investor Show, and turned to podcasts and stuff like that. But when I was on YouTube, my son, who's 6 now, he was 2, his name is Wesley. He was sitting on my lap in the beginning. And as the channel kind of grew, I was teaching him to invest. And we ended up in 2015 authoring our first book, which was Wesley Learns to Invest. Because, you know, even though he's at the age of 2, he was picking up on these different investment knowledges and topics and stuff like that I felt was important. Because when I learned about the world of investing, I always kind of asked my parents why they didn't do it for me. And my parents, my dad, you know, had awesome parents, but they're like, well, you know, we just really didn't know about it like that. So I was like, well, and they said, if we had known, we would have done it. So I thought it was very important to pass it on to my son. We authored the first book, Wesley Learns to Invest, and then it turned into a cartoon, then it turned into merchandise, stuff like that. Ended up becoming a finalist for Shark Tank last year with the idea. Then we went off and we wrote the second book, which is titled, that just released this year, Wesley Learns About Credit. Awesome. So it just created the line. And we developed the app in 2015, then, you know, YouTube, then it turned into a podcast and radio, iHeart, all the great stuff. So that's pretty much me in a nutshell.
Wow, that's so awesome. Just by teaching see what happens when you teach your kid about money.
That's true.
Right?
Exactly.
Some bribery to teach our kids, but we are going to get some great tips from you on how we can transition this challenging conversation that most people believe that it is, and it is for some people, into an easy conversation that they can involve their children. Okay. And so that is the ultimate goal. So why is it so important for not only adults to invest now, but for children to invest now, regardless of their age?
Well, the thing I say why we must learn now is that, you know, a lot of the financial industry and a lot of people that's going to listen to this or tuned on now that are watching this, is the reason why they're tuned in now because they're trying to learn something, right? And traveling the world, going to different schools and universities, is like, why are these people learning this now when they could be learning this as a child? Because the reason why is that you're never introduced into it. It's never taught to you. It's why we see all these problems financially as adults, that we didn't, all these tools that we could have as preventive maintenance, that we just didn't know about it. And the reason why we didn't know about it is because nobody ever taught it to us. So it's like, how about we introduce it as a child? We're not telling them exactly what to do. So when they get a little bit older, these ideas are not so foreign to them. Mm-hmm. That was because, you know, we get so much things in school, but regardless of what field that you know, Tyra, you know, no matter what you become in life or what field you go into, it's guaranteed that you will need some type of financial literacy, some type of somewhere, you know. So why is something that's so vital to just our existence is completely looked over, and you got to start learning about it once you get your nice job and you start to get a 401k, and you're like, hey, let's figure out what this thing called investing is, when you couldn't figure this out as a child. And cool. That's why I think it's important.
Cool. Now, I got a question. What is a good idea of where people should start investing? Like, what should they look at, or do they need to go into the big companies, or where should they start with trying to research things about investing?
One of the things that I learned and traveled the world and seen and sat down with some of the biggest minds in finance, start with what you know. Look at your credit card. Look at what you buy every day. Look at who is your phone service. Do you use AT&T? Do you use Verizon? Do you want to? What channels do you watch? Do you go to Starbucks every day and grab a drink or whatever the case may be? Start with things you know. So a lot of times when people start off investing, they jump into something they have no clue about. I have people call me from Starbucks. Hey, I heard about this thing in China. It's this underwater gas. It's going to come out next year. It's doing this. I heard this person write about it and that. But you're going to Starbucks every day. You've been faithful with Starbucks for the last 10 or 15 years. Nothing in your head says, hey, Maybe just look at Starbucks. Or a person comes in, they eat at McDonald's every day. You take your kids to McDonald's, or you go to Walmart every day, or you're on Amazon. You're on Amazon buying something all the time. Look and start with things that you know. Right now, we're all on Facebook, right? So look at the things that you use and touch every single day and start from there.
I love that. And that could be a project for families. That was one of the things that I encourage families to do, is to have the children to go all the way around the house and look at the things that they like the most, or that they eat the most, or they play with the most, or whatever. And then we start doing the research backwards. We find what it is. Who owns the company? Is the company public on the stock exchange? What is their stock symbol? What is their performance? How much the stock costs, and all that stuff. Because then you have a new perspective on buying things. I had a gentleman, one of my clients, who bought Nikes. Every time Nike came out with a new shoe, it used to irk me all the time. He would pay over $200 for these sneakers. And I said, look, I'm not going to be mad at you for buying sneakers if you at least own the company. And so I convinced him, instead of buying a $200 pair of sneakers, to go and use $200 to buy some stocks, or a portion of the stocks. And at the time, I think it was around $55 per share. And so he did that. Now, every time he buys sneakers, okay, at least it's helping a company that he owns. But he turned around and he said, now that I own the company, I don't buy as many sneakers. I look and see who else buys the sneakers, and I check and see what's happening. So that changed your whole perspective when you take ownership of a company.
Exactly. And I say it helps as well, because now you don't feel as bad when you go to pay your AT&T bill, or you get that new iPhone, or you, like every day you go to work and you sit down at a Windows computer, which is Microsoft. You're like, hey, you know what? At least this is helping me in a way. Right.
Absolutely. Absolutely. So when we're talking about, one of the things that I love talking to kids about is Robert Kiyosaki's Rich Dad, Poor Dad.
Mm-hmm.
And what I learned about an asset versus liability. Okay. Asset puts money in your pocket. Liability takes money out of your pocket, regardless of what it is. But in this world of finance and investing, there's what's called asset and depreciation. And so when we're trying to teach kids about assets and depreciation, how can we explain that? One, let's talk about what it is. And then how can we explain that so kids understand what assets and depreciation is and how it affects investing?
Well, I explained it, in the book titled Wesley Learns to Invest, that came out with 2015, like 2 years ago. And one of the ways I explained it was, he wanted a new toy, right? He wanted a new, like, for prime example, it's with a PlayStation 5 that's going to come out, right? And I said, hey, well, if you buy this PlayStation 5 right now today, it costs $400. When you purchase that PlayStation 5, how much you think it will cost the next year? In 2017, how much would a PlayStation 5 cost? How much would it cost in 2018? We all know that as time goes on, as we use something, the price of it goes down. It's just like right now, we're on iPhone 7. You purchase the iPhone 7 today, guess what? Next year, if you purchase today for $700, what is it probably going to be worth next year? What is it going to be worth when the iPhone 8 comes out? What is it going to be worth when the iPhone 9 comes out? And it's the same thing when you break it down to a kid who wants the PlayStation when we get to 5. You want a PlayStation 5 today, how much do you think it's going to cost today and tomorrow? And you can use it in your everyday life. When they purchase the shirt, when they buy a shirt off the rack at wherever you shop at, let's say the shirt costs $20, a t-shirt. You ask them, if you go to school tomorrow, how much you will be able to sell that t-shirt for? Most of them won't be able to sell it for 20 bucks. They might be able to get $5, so they may not be able to get it at all. That is depreciation, because you purchase something that is depreciated in value, which means that it will lose value over time. Like today, we're on the iPhone 7. We know it'll be an iPhone 8, it'll be an iPhone 9, it'll be an iPhone 10. Today, the iPhone may cost you brand new $700. What would it be worth next year? We all know, and it's the same thing as adults. When we put on our big kid underwear and shoes, we know that it's the same thing with cars. When we purchased that brand new 2017 Ford truck, it cost me $40,000, but as soon as I drove it off the lot, it's worth $35,000. Next year it's worth $30,000, and we know it's depreciating. So we look at the children, we say, hey, look, this is what you're purchasing, something they like. Look at their video games. You purchase their game, hey, look how much this game cost when you brought it. You paid $60 for it. Now you take it back to GameStop. and you try to turn that same game in 6 months later, it's not worth $60. You're lucky if you can get $30.
Right.
That's a prime example of losing value. Now, when you look at something on the asset side of the house, instead of, we said PlayStation. The company that makes PlayStation is Sony. So we say, hey, the people that make Sony, you can become an investor into Sony. Right now, the shares of Sony are $40. I don't know off the top of my head, somewhere between 40 to 60, if I'm not mistaken. By the time you purchase it today, this can go from $40 that you purchased today. It can go to 50, it can go to 60, it can go to 70, it can go to 80. That is something that can grow in value over time. Now, on the reverse side of that, it can lose value at the same time as well. But the thing you're thinking about it is, when you purchase that video game, that's a guaranteed loss. You know that thing is going to lose value. But if I invest into the company, I at least have the possibility to make money in the future. Whereas when I purchase a video game or when I purchase these goods, they are guaranteed to lose value, versus when I invest the assets, I at least have the possibility of an upside.
Okay, so it's the same thing as assets versus liabilities, okay, y'all?
Mm-hmm.
So assets put money in your pocket, liabilities take money out of your pocket. Just like your home, if you have a home that you live in your home, yes, everybody may say it's an asset, based on Robert Kiyosaki, and I believe this as well, if you owe a mortgage on it and you're not making money off that asset, it is a liability. It's only an asset until you sell it, or if you turn it into a rental property and it makes you some money. So think about it this way. Assets bring money into your pocket. Liabilities take money out of your pocket. In the same respect of what Prince was saying, assets, owning a company, ownership means own your ship, right? So if you own the company, that's an asset because you have potential income coming in your pocket. But depreciation of products and services, or products at least, that we like to be as being a consumer, we're consuming all of these products, which are depreciation. So you buy it for an amount today, and later on, it could be tomorrow, it decreases in value. And so a lot of people like to invest in depreciating items and wonder why they're still broke, where they could probably put half of the money that they consume or put in depreciating items and buy the asset side of the column. So when they do buy the depreciating items from the company, you're building up your asset side of your column as well. Do you get it? I hope so. So I love that analogy in helping people understand that. Kimberly, thank you for joining us. She had a question. She said, my kids are 4 and 6. What is a good age to start teaching them about investing? I say now. But if they understand the concept of money or whatever, that's me. What are your thoughts?
I say exactly, like I say now, when, looking at the investor show, when it started off, Wesley was 2. He couldn't even talk. He was just sitting on my lap, just chewing on something. But now when I ask him today, hey, what is a stock? What is credit? Or what is a dividend? Or what is, even though right now in his head, he's just reciting things, but it's just beautiful to see, because I didn't learn that stuff till I was, almost 30 years old with an MBA. So that's why I think it's so crucial to where it's never too early.
Awesome. So what should people start doing? Should people save or invest?
Now, the thing about saving and investing, saving is amazing. Saving is awesome. If most of us at a young age, most of us are not taught about investing. And if we are taught about investing, we're taught about saving. But the thing we got to think about, that's what my parents taught me. My dad is 71 years old, and he says, hey, son, save. But in his generation, savings accounts used to get 3%, 2, 3, some even got 4%. So we know, Tarra, that doesn't exist no more today. On a savings account, you're lucky if you can get 1%. Most savings account, the national average is 0.25.
Yeah, exactly.
0.225 is what the national average on a savings account, which is fine. Hey, something is better than nothing. But it's this thing called inflation, and inflation is the price of everything that goes up. Like, right. Tarra, think about when you was in high school and you had $1 and you walked up to a vending machine. You probably could have got a whole meal. You probably could have got some chips, some sodas, pack of chewing gum, or whatnot. But those days are gone. Now you walk in, and then in my generation, we could go there and we used to be able to get a pack of cookies, maybe 2 pack of cookies. Now this generation, you walk to the vending machine with $1, you need another quarter just to get something to drink.
Well, you need $2 to get a bottle of water.
Exactly, right? So that's showing you that the price of everything is going up. That soda is the same. That bottle of water is the same, but people don't notice. And it used to be 20-ounce Coca-Colas, but now there's 16-ounce that are, $1.25. But the price of everything goes up. Gas prices go up. Everything goes up. So the thing about it is, if your savings account is moving like this, but inflation is moving like this, then you're actually losing. It's a national average of inflation moves about 4%, 3 to 4% annually. If your savings account is only getting you 0.25, you are at a negative, if we say 4%, you are at a negative 0.375 annually. So that's how you're losing money every day by not investing. So if you're guaranteed to lose, if you're just saving, saving is good because it brings you liquid. Hey, I need this money tomorrow. I need it today. I don't have to do it. But when you look at other investment vehicles, you have to put your money somewhere where it can at least match or beat inflation. Right. So that's the difference between saving and investing. When you save, yes, you're guaranteed you're not going to lose anything, but it's almost a guaranteed loss with the price of everything just continues to climb and climb and climb and climb. And then now, look at my generation, look at your generation, you talk to your grandparents, oh, a can of soda used to cost me a nickel, and this used to cost me 25.
Well, that's when they called it pop. That's what they called it.
Exactly. So that's the difference between saving. So saving is good, but you have to think of this thing called inflation, and it's continuing to climb. When you think of Kimberly that wrote in that said she has a 4 or 6 years old, 4 or 6 year old, today you're buying a Coca-Cola for $1. Imagine what they're going to be paying when they're your age. So you have to find something. If your savings account not going to keep up with it, you have to put your money in places that has the potential to at least let you keep up with this growing economy.
I agree with you. You can't save yourself rich. You can't save yourself to a millionaire. You can't do it. And saving is meant to be a foundation. For example, you can build a firm foundation, but it's not going to give you the house. It's just going to be a firm foundation. So you still have to invest to build up a house. So you have some place to live. And one of the things is that most people don't understand, and this just is the economist in me, so I'm about to bore y'all for one quick second. The reason why the dollar is not really, savings is not really all that good is because the dollar lost its value when it changed from the, gold-based system in 1971 or something like that. I think it was Nixon or something.
It was Nixon era. I think it was
Nixon era where he changed it from the gold-based system to currency. Okay, when the dollar became currency, you have to think of currency and current. It's ever moving, ever flowing, and it's got waves, ups and downs. So the dollar can lose value in it. That's why if you go to other countries and they may say, yeah, I want the dollar, they look at you like that's not worth anything. So because the dollar is ever moving, its currency, it's not backed by gold. It's not, some people call it fiat money or playback, because we can print as much money as we, want to nowadays. I mean, at least the Fed can, and correct me if I'm wrong. That is I love researching the economy and all of that. So you have to put money somewhere where it's going to have some value. You have to invest it so it's going to grow. And exactly, the inflation is what's going to get you. Yeah, you have your baseline for emergencies, opportunities for the savings, but where are you putting your money that can at least match or beat inflation so your money can keep up with the rising costs of life? Right?
Mm-hmm.
Okay. Yeah. So let's find, most people say, you know what, I want to start investing, but I don't have hundreds and thousands of dollars, or I don't have thousands, I don't even have hundreds of dollars. Like, where can they find the money to invest, or how much does it really cost to start investing?
And that's true. That was something growing up. When I heard the words Wall Street, I heard the word investing. That was immediately my brain thought rich people. So that was like out of the way. That's rich, right? And when I wrote my first book, that was one of the things they were saying about the title. Maybe you shouldn't put the word invest because that'll scare people, because they're like, hey, I can barely make it through life right now. I don't even have a savings account. You talking about investing? This guy's crazy. I don't have the money for it, But just think about it in a very simple way. And when you look at the best investors of all time, and something that I learned from my own experience and stuff like that is, it's not a try to get rich overnight. It's not to try to like, hey, I want to hit the lottery or whatnot. But think about it, right? Like Kimberly said, she has a 4-year-old. Now, if I told you, if you wanted to save $100,000 for your 4-year-old child, right? When they're 20 years old. Now, you tell somebody $100,000, man, that's a lot of money or whatnot, whatever the case may be. But what if I broke down and told you if you saved $15 a day, $15 a day, that's lunch in most cases, right? If you say something, broke it down to if you save $15 a day, and you did that every day for 365 years, that's $5,475,000 per year. You multiply that times 20, and then you're at $109,000, right? So when you look at it, that's no interest, that's no, if you put it over here and you grow this, we didn't even get into what the market could do for you. We haven't even got into if you put it into a CD, no interest bearing account. So if you break it down to say, hey, I have a son or a daughter, what am I going to do? How can I find money to invest? You know what? $5 per day. I take $5, I put it to the side, or I take $1 per day, right? Yeah. If you break it down to the simplest point, when we think of, let's think about, take it for religious purposes, right? If you're a pastor, you want to open up a church, and tomorrow you want to open up a church, and you want to open up a mega church. People would say, well, you're probably not going to open up a mega church tomorrow. But if you start in your garage, then you slowly grow and grow and grow, it can grow into something massive. But if we broke it down to what we did every day, today, open up a savings account. When you got paid, you put $10 to the side for your kids. Don't think about it. And you did that every time you got paid. $10. You got a pay raise, you do $15. You get your income tax. You put, if you do withdraw income tax, you put back some of the income tax back for them, maybe $100 or $1,000 or something like that. Those are the things. Because think about it. On the average, an American parent spends $300 on Christmas per child. For a birthday, the average parent spends $100 to $150 per child. You multiply that, we're talking about how much. Now think about it. You say, hey, you know what? It's $300 at the end of the year for Christmas that I'm going to spend. This year, I'm going to get you $200 worth of prizes, but I'm going to take $100 and I'm going to put this back into your savings account. Every parent has a child's birthday where we take them to Chuck E. Cheese, buy them a bunch of stuff that we know are going to depreciate. Going back to what we just learned, we know this is Gary. We know that we buy Wesley a little tricycle. We know that thing is not going to be worth nothing in a year or two. But
you're going to be tired of it after a month.
Exactly. You be running over with the car. Bam. They're going to get your money. So the thing about it is like, hey, you know what? What we're going to do when it's every birthday, you're going to take back $20 and you're going to put it into your child's account. Every Christmas, you're going to take back $50, put it into your child's, your account. Because think about it. Every Christmas on social media, everybody got these pictures of all these presents up under the table, right? All these things that won't even make it a year. They're probably all being in the trash within a year, won't exist. And here we're going to do it again. But what if you just took that money, took $50? Okay, you know what? I made the Christmas list. $50 is going to go to my son or each one of my children. Savings account. Put your money off into savings. Or when it's time to the birthday, do the exact same thing. If you can do more when you get paid, that's awesome. Now you got it into savings, great. Now you want to go to the investing route. I'll leave that a little bit later. I don't want to go too far.
Well, see, the great thing about that is that even if you want to just do $5 a week, automatic. Acorns is a great way to get started. Mm-hmm. I don't think it's the end all be all, but it's a great way to get started. There's a link on the website, madamoney.com, where you can just get started with $5. So if you want to start testing and, assessing the waters and feeling that, that's why I ask everybody almost every day, how much did you spend today? Because I want you to be mindful of what you're spending your money on. And if you spend a lot of money on food or a lot of money on some other stuff, you could probably spare $5 for your savings and investing, or $10, whether it's $5 a day or $5 a week. You're worth more than anything that you buy at a store. So why not invest in you and your future or your children's future, or just teach them? I taught my son every time he gets money, 10% goes to God and 10% goes to his savings account. Okay. So now when he gets money, he got some money. This weekend I was with him. He's 21. I said, so what you going to do with your money? He was like, 10% is going to God. And I was like, what about the rest? He was like, I'm going to save half. So now he's choosing to save half because he can. Before he starts getting into debt and doing all of that. That's where you want them to start getting in those habits, is when they're young, because it grows with them as they get older. So let's talk about, what type of investments could we start start with, especially when we're involving our children, what type of investments are for the beginners?
Okay. And before I jump into that one, I want to piggyback off what you said earlier. Something that I did with Wesley that you can try at home. You can do it with something as simple as what we did. We took 3 Pringles cans or Stacks cans.
Yep,
The
the
Pringles.
bucket.
Cut the holes in them, right? And all you do is you put 3 of them, because think about it. We always teach our kids to save, put in the piggy bank. That's great, right? But the thing about it is, what if you put out 3 Pringles cans? The first can, when they get paid, you say, hey, this goes into paying your bills. We all have to live. You're going to accumulate some type of bill. Pay your bills. What's the next can for? This is what I save. Why do you save? I save for emergencies. The third can, this is where I invest. Okay, why do you invest? This is to make money. So now, instead of just having that one big piggy bank that you're just throwing money in there and saving, you're putting it in a child's mind, hey, in Wesley room, we put up 3 cans, and one says, pay your bills, save, and invest. So you can do it at home tomorrow. And now you take your 4-year-old, your 6-year-old, you give them allowance, you give them money, or you find change, or whatever I do. I had change in my pocket. Here, Wes, go put this up. What do you do? What's this one? He don't know what it is. He's like, pay my bills, save, invest. One day to click. So, but that's
I need Wesley to click this, okay? So, because I do that to the bucket system. When I go to elementary schools to teach money, I teach them the bucket system. So if they got $4, if they got $1, a quarter goes into 4. You use 3, so we'll teach them that, right? But I always teach them that they save, invest, then pay bills. Save, invest, then pay bills. Because if you pay bills first, you may not have anything left over to save and invest. So you are a priority. God, for me, it's God, then me, and then everybody else. Because and that will help you prioritize your spending. When you make yourself or God and yourself a priority, then you start managing what's left over. Warren Buffett tells you to save first and spend what's left over. Don't spend and save what's left over, because sometimes there's nothing left over. So we want to make sure we teach our kids to save, invest, then pay bills.
If you're working with a deficit, yeah, because sometimes a lot of us
if you're working with a deficit, you want to do that. But if you continue to pay your bill, well, I'm not telling you not to pay your bills, first of all. I'm not telling you not to pay your bills. But at some point, even if you have to get in the habit, even if you're saving a penny for yourself, you have to get in the habit of paying yourself first and then paying everybody else. Even if you start with a penny, and then you can do 2 pennies, and then goes to a dime, and then it goes 50 cents, and then goes to $1, then it goes to 10. You've gotten to get in that habit of paying yourself first, because if you don't, you will always give yourself what's left over, and most of the time, there's nothing going to be left over, because the world is always going to try to take everything you got.
That's true.
So I just say, give them what's left. Don't give them what's right. I'm sorry.
Got you. That's a good one too. But as long as we know the overall premise is that, hey, we're not just saying, hey, we're just saving, we're saving, because we already established inflation will eat that alive. So as long as you understand the principles of, hey, you have to pay your bills, you have to save, and you're putting something to the side to invest.
Yeah, absolutely. Okay. And so let's go back to what types of investments should we invest in?
Okay. So the first thing you got to ask yourself, 3 questions. You got to ask yourself, what is your risk level? Are you high risk? Are you moderate? Or are you a low risk? Then once you know, hey, I'm looking to be very high risk. If you have a 3-year-old, 4-year-old, most investors are going to tell you, hey, you have a long time horizon. A time horizon is, hey, you don't plan on touching this money for 10 or 15, 20 years. Once you decide what your risk level is going to be, now you got to decide, what's your time horizon? Do you need this money next year? Do you need it next month? Or, hey, this is something I'm putting off for 10 or 15 years. Now, when you have that, now you decide how much money are you working with. Now, once you decide, hey, I am high risk, I'm looking to get into the new hot thing or whatever, then you can look into your things like your technology stocks, like Tarra had hit on earlier about your cryptocurrencies and things like that. Now, if you say, hey, I'm moderate to lower risk, and I want to get my kids started in something, I don't know what to get started in, then you can purchase something like a CD. That's the next level above investing, whereas your money is guaranteed or pretty much guaranteed, but you're losing liquidity, meaning that you can't pull it out as fast as you want to. Right. Then you can look into the next level will be something like a mutual fund or index. A mutual fund is a basket of stocks. whereas the index is pretty much the same thing. The index is something like, the Dow Jones, the NASDAQ, or the S&P 500, which is the most popular one. You can invest into that, which is you can invest into that with the E-Trade account or TD Ameritrade account or any brokerage account. You can purchase an ETF, an exchange traded fund that trades just like a stock. You can buy it every single month, and it tracks the top 500 companies in America. That's if you want to go with the index. Or you can get a mutual fund that has a basket of stocks. Maybe you decide you may want to go into technology and things like that. Then once you pass on to that, you're more of a higher risk. Maybe you want to go into an individual stock. Why would an individual stock be more of a risk? Because think about it. If you have 500 companies versus one company, the person who has one company is absorbing a bigger risk. For example, if I was a person invested into the S&P 500, the top 500 companies in America, versus someone else who invested into Blockbuster. We all know that Blockbuster is not here, and we know that Blockbuster has since fell out of the S&P 500. I don't think it ever was even there in the first place, but now Netflix has replaced it. So the person, when you invest in one company, you're absorbing more risk. Mm-hmm. Now, if you want to absorb an even bigger risk, now you can do things as far as getting, new hot stocks, something like your cryptocurrency, marijuana companies that are very hot right now, but they're very volatile, meaning that they move up and down a lot. And what you do is once you have your money, those are the different type of investment vehicles you have. Also, Tara, you can go to the other side of the house too, where there's different insurance vehicles that are investments as well. Right. You can look into getting insurance vehicles for your kids as well to act as a vehicle for investing and insurance as well.
Right, so like a variable universal life or a whole life or whatever, or index universal life and all those, right? Yeah. And so what you mentioned one of the questions is what's your risk tolerance? Hell, I don't know. That's what most people are probably saying right now. How do we determine what our risk tolerance is?
Okay, I would say your risk tolerance. Let's say if you're like, hey, I have $5,000 right now today, and my son needs this, and he starts school at the end of the year, or he starts school next year. So that's money that he's probably going to need next year. I would say your risk tolerance would be lower because you don't want to put that principal at too much of a risk because you need that because your time horizon is short. You need this money within 6 months. Now, if you have, like Kimberly said, she has a 4 and a 6-year-old, you don't plan on touching until they're 18, 20 years old. You have a 15-year time horizon. You can absorb more risk. By you taking more risk with that much time, you increase your likelihood of making more and more profits. So if you have, I would look at it as your time horizon. I have a lot of time with this money, so I can be more riskier with it. Maybe get into some individual companies, maybe get into some indexes, option trading and stuff like that, because I have a long time. I'm not worried about the market collapses tomorrow or whatever the case may be. I have time to recoup because I have a long time horizon. It'd be the same thing if in 2008, some people, it was prime real estate. When the market crashed, someone who was young getting into investing is perfect. Right. But for someone who's looking to retire, it's a nightmare.
Right.
So because I'm looking to use my money now versus someone else is looking to invest for the future. So look at your time horizon. How much time do you have? If you're doing it for a child, are they senior high school? Were you looking to use it next year? Are they in kindergarten and pre-K or first grade, second grade, where you have a long time? If they have a long time for it, you can be more risky with it.
Right. Okay, that's good. So one of the things that you all can also realize with your risk tolerance or how to determine is your age. Like he said, your horizon. How much time do you have in life? If you're in your 50s and you want to retire in your 60s, you're probably a conservative, lower risk tolerance, because if you put it in a high risk vehicle, it could lose a lot of money, and then you don't have enough time in your working life before you retire to recoup it or rebound from it. But if you're in your low 20s or 18 or 15, 16, and you want to do something for the long haul, you probably can do with some risk, because even if the market drops, you still have time in your life to rebound. Pretty much what you said, right?
Yes, that's true.
Awesome. And even though he used the analogy of I got $5,000, I can hear some people saying, like, I wish I could have $5,000. Even if it was $50, $100, or whatever, the same still applies. You want to understand, what your risk tolerance is, just your tolerance to lose money. You know, what is your tolerance to lose money if you should lose money? Are you going to freak out if you lose all your money? Or if you're going to be, well, that's just the price it pays because I'm going to get a big return later on or anyway. So if you're not afraid of risk or you're not afraid to lose your money, you probably have a higher risk tolerance than most people. Me, I don't mind losing some money if I know I'm going to get some return, but I can't lose all my money because I'll freak out. So I am a moderate risk. I don't know if it's a moderate risk or moderate conservative. I'm not sure. But yeah, I'm 40 something. No, I'm 21 with 22 years experience.
Definitely. Okay. Yeah. But you're 100% right. Your risk level, it depends on when you're looking to use this money. You know, I'm looking to use this money in this amount of time or that amount of time, so it can change with every person that may be tuned in and watching this. So that can change.
Absolutely. So a lot of people want to know, you know, before I get into this, should I talk to a professional? What type of professional? Should I talk to a stockbroker? Should I talk to a wealth manager? Well, let's talk about what's the difference between a stockbroker and what is a fiduciary. Those are differences. But what's the difference between a stockbroker and fiduciaries, and what are some examples of fiduciaries?
Oh, yeah, great question. The difference between a stockbroker and a fiduciary pretty much boils down to one person is a fiduciary is legally bound to act within the best interest of their client, versus a stockbroker is a broker. Just like you would look at something like a real estate broker. You're looking to buy a house for your budget. You're looking to buy a house for $100,000. There's find someone who's looking to sell a house. How that play with a stockbroker? You go on today, you're looking to buy for stock for $12. You got to find someone who's willing to sell it for $12. Once you find those two people, he's brokered the deal. Same thing with real estate brokers, and anytime you hear the word broker, they're the person that matches the buyer and the seller together. A fiduciary, on the other hand, is a person that just like a lot of different people in the financial industry, they must abide by the fiduciary rules, meaning they must act within the best interest of the client. So a stockbroker doesn't have to act within the best interest. You call, like for prime example, you can start an E-Trade account today and buy whatever the heck you want to buy. And they're going to find somebody that wants to sell it to you, and they're going to sell it to you. If that stuff goes to zero, or if it went to 1 million or trillion or whatever the case may be, E-Trade does not, hey, good on you. All they're going to do, they're going to get their broker fee. They have no responsibility of acting within your best interest. They're going to give you the tools that you need. You said, hey, I want to go buy Ford stock today. They're not going to be like, well, we don't know. What is your risk tolerance? This is good for you. This is not a good company. This is not a good time. A broker is going to say, hey, you're going to buy this, and they're going to give it to you, which is nothing wrong with that. The thing about it is people think the broker is acting within the best interest of them, which is not bad. Not saying all brokers don't, but they're not legally bound to act within your best interest. Versus your fiduciary, passing the Series 65 exam, they have to act within the best interest of their client, or they can face up to 3 years in jail. For prime example, if you say, hey, I'm moderate, and I jump you into cryptocurrency, and cryptocurrency fell apart or whatnot, or Bitcoins or whatnot, they fell apart, then guess what? They're going to say, hey, this was a moderate investor. Why would you purchase them something of a high risk or whatnot? Right. So that's the difference. One person must act within your best interest, whereas the other person is pretty much almost like a car salesman.
Exactly. So for you all that, for example, fiduciaries example, I'm a fiduciary, a licensed insurance agent, and we're, involved with financial services and financial institutions, right? Financial institutions are fiduciaries. There are some wealth managers that are fiduciaries if they have their series. Real estate agents, agents are fiduciaries. Now, brokers, when you're talking about brokers, that's why you have a brokerage house that has real estate agents, right? The brokers broker the deal. They get the inventory, they have it there, they broker the deal. The agents find the customers, listen to what they want, make them feel better, take them all around the world to find the perfect house, and help them through the process, help them with their credit and all that. And when the deal comes together, then they consult with the broker to broker the deal, okay? That's why you have insurance agents, because we have to do the right thing by the customer. That's why you have, like I said, wealth managers, Series 6. That's why it's so big, FINRA regulated. They are protecting the consumers because they don't want someone to put someone else in a high risk vehicle just because they're going to get paid more commission.
Mm-hmm.
Okay? And it's not to the best interest of the customer. We can go to jail for things like that. So that's why it's important to understand who you're talking to. Are you talking to a broker? Or are you talking to a fiduciary? Someone that's going to operate in the best interest. Now, I'm not saying that all fiduciaries do operate in the best interest, but they are supposed to by law. Okay?
Now, Tara, to piggyback on what you said, how they're paid. Figure out how they're paid. Like E-Trade or a broker house, anything, they're paid by what is brought and sold. Right. You purchase it, they pay by transactions. That's it. So a lot of brokers like, why is this broker calling me trying to sell me this? They don't care. They're trying to get their commission off of whatever they're selling, right? They could be, not saying that they all are. A fiduciary in most cases are paid by their fee base, where they get a fee of what they manage. For prime example, the industry standard is somewhere between 1% and 2%. So if you're managing $10,000, if you got a $10,000 client, if that client accounts turns into 15, 10, 20, 15, $1,000 or whatnot, that's great on you. So because that means your 2% gets bigger and bigger and bigger. Versus if that account goes from 10 to 8 to 5, guess what? That commission is smaller. So also on top of that, that fiduciary has a little bit more incentive to grow that account or to grow your assets.
To grow your assets and to protect your assets. Absolutely. Absolutely. And it's good to understand that because one, you should consult with a professional. You just have to be very careful which professional you talk to, depending on the type of information or your financial IQ or your understanding of it. So you might need someone that's heavy educationally based when explaining information, like Prince. Prince will help you understand and educate you on that, investing and so forth. There are some investors that don't have the, investment managers that don't have the patience. So they're like, do you want to invest or not? And just give me your money and I'll do the rest. And that's not always what you want. You trust but verify, but you want someone that's going to help educate you, teach you how to fish, not just throw you a couple fish, right? Absolutely. So, we understand what the assets versus depreciating items are. We understand that we need to save as well as invest. We understand risk tolerance a little bit, and the best way to teach a child about risk tolerance is how okay are you with losing something, or losing money, or how are you okay with losing your toys? Which toy don't mind losing? Okay. If the kid is not worried about losing any of their toys, they're probably a high risk child. No, I'm just kidding.
High risk child.
But we understand that. We understand the professionals, the brokers versus fiduciaries. Now we have a little bit of money. We've saved up $100. We want to start investing. How in the world do we start investing, and how do we get our kids involved with starting to invest?
Well, that's a great question you ask. And if you have your kids, you can open up a custodian account for them, just like you can do a checking or savings account. You can open up a custodian account for them via, a lot of brokers. For example, TD Ameritrade, Scottrade, Charles Schwab. At the end of the day, people are like, well, which one should I use? I don't know. It's just like if I ask you, I say, hey, Tara, I'm trying to get onto the internet. Which type of computer would be the best? You're like, well, it depends on what you like for your feeling. No matter if you got an Apple, a Mac, a PC, a Toshiba, or Dell, whatever, you're going to go to the same exact internet. We're all going to end up on Google at the end of the day. Now, someone may be a nice processor or whatever the case may be, but that's all you feel. The same thing. If you don't matter which broker house you go to, if we all buy forward stock, we're all going to have forward stock. So once you decide which one that feels comfortable for you, you can go to YouTube, you can Google, whatever the case may be. You can use your local bank. That someone may have brokerage accounts or whatnot that you can open, or you can just go online. You can go online, start a custodian account. I have plenty step-by-step videos to show you that, to show you how to set up an account for your kids on TD Ameritrade, Scottrade, not Scottrade, but TD Ameritrade and E-Trade. Hey, set up an account for your kid. You got this on there for your kid. You can take that money out of that savings account, have it transferred into that E-Trade account, make it fun and interactive for the kids, and say, hey, well, you said you liked it, what, Under Armour, or you liked Nike, or whatever the case may be, and you can make it fun. You guys can invest for them. And then you can go on and purchase stock and you can watch it grow and things like that. So all it takes is you to go on there. Most of them, they don't have a set amount they want you to do, but they do want you to buy, right?
Mm-hmm.
If you open up an account and you don't do nothing with it for like 60 days, they're going to close it because it's inactive. Because we already established how brokers make money is by you buying and selling. So once you get there and you buy something, you establish your account. Hey, let's get 2 shares of Under Armour. Let's get 2 shares of Nike. Or, hey, you know what? I've been a faithful AT&T Verizon customer. I've been driving a Ford for 50 years. That's a family dynasty. So we're going to buy a Ford. We're going to buy a Ford. Then my son saw that he loves the PlayStation, whatever, like you said in the beginning, Tarra, the exercise. You find the company's publicly traded. You could go on and purchase it just like that. And just that simple and easy, you started investing. And every time you get paid or every time you have that money set up, or you can have your kids when they do chores or if they recycle stuff or whatever they do to generate income, you take that and you make it fun because you guys can sit down and invest together.
Awesome. So that's a great way, especially go to the YouTube and look for the Investor channel and look at the Investor Show. He has awesome videos on how to set up custodial accounts. But also our sponsor, Acorns, you can go to madamoney.com, go to the free Mad Money class, and then there is a link for Acorns and you get $5 for starting, and you can set up an investment account. At least there you can have multiple investment accounts. So at least you're getting your feet wet with starting however way you want to do it. Just get started. Like Nike says, just do it.
Just do it.
Yes. Yeah. All right. So how do we monitor and collect dividends, and what should we do with the dividends? Should we cash them out? Should we reinvest them? And what are dividends anyway?
Dividends are essentially when you invest into a company. When you buy a stock, you're buying a share of a company. That company is going to take your money. Let's say if it was Nike, they're going to create more shoes. They're going to market their current shoes. They're going to endorse other people. What would they can do to generate more income? When that more income is generated, they're going to divvy that out to the investors. And that's what you get in return is called a dividend. The dividend can range. Dividends are not guaranteed, but you can see how much a company is paying in dividends, and you can see the history of paying in dividends. Companies that we listed, AT&T, Verizon, I'm not endorsing any of them. I'm telling you to purchase them, just telling you the truth. They have a history of Nike. All these different companies pay dividends. So usually they pay them quarterly, some pay semi-annually, or some do annual basis. They could range anywhere between 1 to, I've seen some go 10% in dividends. So hint to that whole, how can I keep up with inflation? That could be a possible way.
So dividends are different than the interest that we earn from the stock, right? So as the stock grows up, the dividends are different than what we earn based on the growth of the stock, right?
Yes. So if you purchase a stock for $20 and it goes up to $25, that's just appreciation because of an asset. Just like you buy a house for $100,000 and the value of it goes up and you get equity inside of the house, that's just the value go up.
That's the equity in the stock.
That's the equity.
Depreciation is like the bonus.
Yes. The dividend would be
the dividend.
The dividend would be like a bonus. Most of them, like for prime example, right now, AT&T and Verizon pay between 4 to 5% annually. They pay them out every quarter. So at the end of that quarter, it's going to cut you a check. It's going to say, hey, congratulations. You have earned whatever it is, $2, $5, $20, $100, and $200. That money is going to go straight to your brokerage account. What you could do is you could have that money reinvested into something called DRIP. It's DRIP, the Dividend Reinvestment Program or Plan.
Yes.
And what that does is it takes your money and it buys you additional shares of that particular company. So you say, hey, instead of giving me the $50, I want this money reinvested. Now you collect over, I want to say, according to the previous tax code, about $600 in dividends, then you have to pay taxes. Uncle Sam is going to want his piece. But you can have it reinvested. It's almost the same concept of compounding interest, where the money's coming in, so you can buy one share of a stock and not touch it for 20 years and probably end up with 3, 4, 5, or up to 10 because those dividends are slowly being reinvested and buying you additional shares.
Awesome. And so, I just thought about it, and this, I have to preface this. This is by no means me making any recommendations of any stocks whatsoever, because I am not licensed to do so, nor do I want to be. But you're realizing that I have been with Verizon for too long. Many. And as much money as I pay for my Verizon because I need the coverage within that, I do not have Verizon in my portfolio.
Wow.
That is so going to change.
That was one of the companies that
is so going to change.
That was one of the things my dad, it was me, my dad, and my brothers, we all used Verizon. My dad was looking to invest, and I'm like, let's go with Verizon. That's something you know. You're not trying to get out here and do nothing crazy.
And
you
it's
know,
around,
we giving it,
it's
$100,
around
$200 a month.
$45 a share. It's going down a little bit, which to me means it's on sale. That is, because I just paid my Verizon bill today. And for the amount that I paid for my Verizon bill, yeah, that's so gonna happen.
Think about it, Tarra. It's Verizon also
any type of investment advice at all. You do you, but for me, that's just so gonna happen.
And think about it. Verizon is paying like 4%. It's been paying 4% now for, I know, at least since I've been holding it for some years now.
I know one thing that I should have did. I should have bought McDonald's when it was under $100. I think now it's at $152 per share or something like that. As much as I ate McDonald's I don't eat it as much as I used to, but as much as I made somebody a lot of money. Whoever owns McDonald's, you're welcome.
Yeah, that's true. You know what? We're talking about companies. We're not talking about, hey, let me jump over here. You're talking about things that you exactly use. And we didn't even bring up McDonald's is another one that pays dividends. So those are dividends, and that's the appreciation that your value could have gotten. The thing about it right now, we're in a bull market. Right now and that's a thing that I see a lot of new people that come to the market that are way newer than I am. They're like, hey, I purchased this and it's doing awesome. Right now we're in a bull market, meaning that it's going up. So it's kind of hard to miss over the recent couple of years. So you can look at pretty much anybody: Starbucks, Amazon, Google, Facebook.
Okay, y'all.
Apple.
Amazon hit $1,000 a share, and the reason why is because they bought Whole Foods and they just put out a Prime wardrobe. So you have to think about this: if you had money, if you had stocks in any type of grocers, Kroger, any other grocers that are on the stock exchange, they took a nosedive as soon as Amazon announced Whole Foods. So you took a hit, right? But Amazon did it again on Tuesday or today, where they made the announcement of the wardrobe. So if you have money in Macy's, JCPenney's, they took a nosedive today just from the announcement.
And that lets you know, because why did Amazon go up on Friday? It was all news. It wasn't, hey, that's straight emotions, that's straight press release, that's just media. So everybody's like, oh, blah, blah. You're talking about Whole Foods went up 25 to 30% off of what? What fundamentally made them right? Just off an announcement. So the thing about it is, when you look at those things, you don't buy it. And when you look at the guys who took a nosedive, those are the guys you do buy. Because why did Macy's go down? Did it do something different? Did it lose money? No.
And it didn't back up. And when those things happen, when those nosedives happen, especially if I look at the performance and they naturally progressively go up, and it was just based on something that happened, it's a situational type thing that knocked them down, that means it's on sale. Y'all want to do a Macy's sale? Do a Macy's sale when their stock drops for no damn reason. How about that?
Think about it. Look at the BP oil spill. When a big BP oil spill, the stock took a nosedive. But that was the prime time to buy BP oil. So those are things about it. Yep.
Those those so high. But the oil industry is taking they're in a bear market right now.
Yeah, the reason you got to think about it, and people always ask me about oil, and I say, well, look at it. Everything that comes out, every new piece of technology, everybody's trying to move away from oil or use less and less oil. That's why I'm very finicky on the future of oil, because if you look at the new cars that are coming out, they're using less and less oil. Heck, they're even jumping over to, electrical cars. Every piece of machinery, everything that we come up with, we still rely upon it, but we're doing more and more and more to move away from oil.
We are, but the problem is that the administration, when they dipped out of that thing to help the economy and the world and all that, that's what would probably have paid, funded and supported all the electronic cars, the electronic efficiencies and all that. When we dipped out of that and we're trying to stay in the Stone Age and stay with the oils and the coal and all that stuff, but now you have those folks that are Tesla and all of them, GM and all of them that are coming together, now they're trying to form something similar to what was out there so that we can use less oil, so we can pollute the world less. So I'm curious as to how that's going to work out. But I had to pull out of my oil stocks because
but yeah, that's so when I look at the, because you got to think about it. When oil was at an all-time high, that's when everybody brought it. When everybody was at that gas pump paying $3 and out here in Hawaii, $4 or $5 a gallon and stuff like that, you know, people was like, man, I need to get invest into this. It's the same thing when people see something run up, they got into it. And all it took was oil is a natural resource, and it's all based off of supply and demand. If the demand for oil drops, then because the supply is pretty much going to stay the same. We're not creating oil.
The problem is that they talked about the supply going up, but we don't see the demand going up. And so if the supply is going up and the demand's not going up, that drops everything.
Because and the reason why the supply is going up because they just find newer and better ways to get to the oil. Now, you know, back in the day, we couldn't use fracking, and we couldn't go out to the middle of the ocean. Now the technology allowing us to get more oil, so now the supply is going up. But guess what we're saying? We're like, hello, Tesla, hello, General Motors, let's come up with an electronic car where we're moving away from it. Every new car that hits the street, everybody is using less and less oil. So when I see the supply going up, demand goes down. Yes, it could be a good time to buy, but I look at what is the real. Yes, oil will be around, but what is the future? The supply is not changing. You know, Earth is created. The only way they can change the supply is when they have those OPSEC meetings and they say, "Hey, stop pumping."
Right.
But people they competing with each other. This one don't want to stop pumping. He doesn't want to stop pumping.
Right.
So when I look at the future, I'm like, I don't know. I don't see us moving into the oil age. You know, so.
We're gonna have a part 2 of the investing thing, because I have questions about the railroad industry, because I don't see that going anywhere. We're always gonna need trains no matter what. Because
that was our first industry.
Man, that was the first industry, and it's still going strong. So I got a lot of questions about that, and so. But thank you, Prince, so much for sharing your information and helping us to teach our kids. The way we teach our kids is we start at home. Make it a family project. The first project is to go around the house and see what we love to eat, love to play with, our favorite toys, and then find out the manufacturers, who makes it, who's the company that owns those products, and then are they on the stock exchange? If they're on the stock exchange, how much does each share cost? Look at the performance. Are they continuously going down, or are they going up and down, but moving in an upward manner? And is it reasonable? Maybe the family, hey, if we save this amount of money in 2 months and we put it in this family brokerage account, maybe we can buy a couple shares of McDonald's, or we can buy a couple shares of Nike, or we can buy a couple shares of Verizon after I pay my damn Verizon bill. How about that?
That's true.
Johnson & Johnson. How many of you all use baby lotion, baby powder, all of those? And yeah, they took a hit because they had a class action suit around them, but it doesn't stop people from still using the products and still buying. General Mills. How many of you all eat cereal from General Mills? Things like that. So that's a great way to involve children in the process of learning to invest, but it also helps adults to learn to invest, so they're learning together. And I don't care how young they are, if they know that this dollar bill is going to buy them something they want, it's time for them to learn about money. It's time for them to learn about savings, investing, and how to spend responsibly. Right?
I agree.
Look at him on his phone. Boy, it's time to go. All right. So, Prince, tell everybody how they can stay in contact with you or work with you.
I'm all around the place. You could just type my name into Google, Prince Dykes, PRINCDYKS.
Oh, no, he did. He said, Google me, boo.
I'm Googleable.
I'm Googleable. Just Google me, boo.
That's what happens when you have a strange name that nobody else wants. You just pop up. Nobody else wants to be Prince Dykes. Right. Exactly.
Oh, he is so royal, Prince. What's your company's name?
Royal Financial Investment.
I wonder where you got that from, Prince. Yeah.
That did happen there. That was a correlation. But I'm on Facebook, Prince Dykes. I have the Investor Show on YouTube. We have the podcast, which is on iTunes, Google Play. Anywhere you can get podcasts is the Investor Show. We have the YouTube channel, my personal page, Prince Dykes. Then I have the Investor Show, which we just started up on Facebook. Royal Financial Investment Group is on Facebook, which they had up overall the company. We have Wesley Learns, which is a kids brand for teaching them how to invest. Wesley Learns is on Facebook as well. Wesley Learns to Invest on, we're on Facebook, Instagram, Twitter.
Wesley Learns to Invest is my book of the week. So you can go to
MadamMoney.com
and you can get a copy of Wesley Learns to Invest.
Definitely. Thank you. Appreciate that. Appreciate it.
Oh, my pleasure. That's a special place to be, my book of the week. I don't like a lot of books. No, I'm just kidding.
I know he said I don't like all these different books. I definitely appreciate it.
You got to be special to be my book of the week.
Appreciate it. Thank you.
Awesome. Well, thank you so much, Prince, for hanging out with us. Thank you, everyone, for watching. Stay tuned for more. Make sure that you go to MadamMoney.com for all of your financial needs, because I make money matters manageable, absolutely, and give you the insider information about all things dealing with your money. I appreciate you so much. I love you. There's nothing you can do about it. And okay, question of the day: how much money did you spend today? Remember, there's no class next week or the weekend on the 4th of July, so make sure you have a wonderful holiday, and we will see you in July. Deuces.
I had a